Today we want to review the steps for closing in order. Just basically, what is the process? What steps do we walk through? So try and just take a minute here and just see if you can just kind of list them from memory. All right, so let's see what you got. First step we want to do is, remember, we take the revenue account and we take the money from the revenue account and transfer it to the income summary. Step 2, we transfer the money from the expense accounts into the income summary. So steps 1 and 2, we're taking the money from revenue and expense, putting them in our income summary, which is another temporary account. Step 3, we're going to take the money now from the income summary, and we are going to transfer that by closing it out into the capital account. And our last step is we have the withdrawals account, and we're going to transfer that money into the capital account as well as our last step. And then we should be all done with the closing process. Then we need to, if you remember, our final step is to post those transactions, those closing transactions, and to create the post-closing trial balance to prove that things are still in balance. So what we want to look at first is closing the revenue account, and we want to ask a couple questions. So try and fill in these blanks, and then we'll show the answers here. To close a revenue account, the balance must be reduced to what? 0. Okay, anytime we close an account, we're reducing its value to 0, or its balance to 0, so it can start the new accounting cycle fresh. If a revenue account has a balance of 2,000, remember, a revenue account has a balance of 2,000. The normal balance side for a revenue is on which side? It's on the credit side. So to close out this account, would we use a debit of 2,000 or a credit of 2,000? Remember, the balance side of a revenue account is on the credit side. To close that out, we need to give a debit of $2,000. Number 3, when closing a revenue account, income summary is what for the total amount of revenue? So remember our rule for transactions. For every debit, we need equal credit. If we debited the revenue account for 2,000 to close that out and reduce it to 0, the income summary, therefore, is going to have a credit of 2,000. So let's just look at our T accounts here. We have fees and income summary. Currently, we have a balance of $2,000 in our fees. To close out this account, we need to give a debit of 2,000, which will give us a balance of 0 in our fees, and a debit of 2,000 requires a credit of 2,000, which would go in the income summary. Now, let's look at our balance of 0 now. Now what we want to do is we want to take this information that we set up on the T account and we want to actually journalize this entry. So remember, when we create a journal entry for closing entries, we start off our page with the words closing entries, as you can see here on the screen. The date 2016, again, we write that once. Now we write our date, December 31st, which is the date that we were told that this accounting period ended. So we have December 31st. Now, when we write our journal entries, we write the account being debited, which in this case is our fees, for an amount of $2,000. On our next line indented, we write the account that is being credited, income summary, along with the $2,000. So this is the complete journal entry for the closing of the revenue account into the income summary. And now again, the difference with this journal entry is that we have the words closing entries at the very top, and we no longer need a third line that shows the description or the reference to the source document, because this is a closing entry. Alright, so let's look at the next step, and we'll go through this one a little more quickly. We have the closing of the expense account. Again, if you close an account, it reduces to 0. The expense account has a balance of $800. And so just as And remember, the normal balance side for an expense account is on the debit side. So if you look at the T account down below, you can see the examples. All of these expense accounts have balances in the debit side. So to close out an expense account with a balance of $800, you're going to need a credit of $800 to reduce that balance to zero. Also, when closing the expense accounts, we give a credit to each of the expense accounts. The income summary, in line with our rule of transactions where every credit requires an equal debit, every debit equal credit. The income summary will have a debit for the same amount. And now here's where we're going to look at some compound transactions. So if we look at these T accounts, we have the advertising expense with a balance of $400 in the debit side because it's an expense. Expenses have a normal balance on the debit side. So we'll close out the advertising expense with $400, miscellaneous with $200, rent expense with $600, utilities expense with $300. We sum up all of those expense accounts, all of those closing amounts, for a closing entry in the income summary of $1,500. Now let's take this information again from the T accounts and we're going to add it to our general journal. Here's our journal entries from before showing the transfer, step 1, which is the transfer of revenue to income summary. Next, we're going to add the date. We don't need to enter the month again because the month didn't change. We still need to enter the date, the day of the month. Now, in this case, income summary received the debit. So income summary shows up first with a debit of $1,500. And now we're going to show our compound entry, which we're going to start with advertising expense with a credit of $400, miscellaneous with a credit of $200, rent with a credit of $600, utilities with a credit of $300. And again, if you add each of those up, they will total the amount of the debit. Debits must equal credits, always. Step 3. Now that we have our income summary populated, you can see down at the T account, we have debit with a closing of $1,500 and a credit with a closing of $2,000. Remember, credits represent revenue, debits represent expenses. So if we look at our T account at a quick glance, we can see that we have greater revenue than expenses. That means we have a net income, and our balance would be $500 on the credit side. If our debit was higher than credit, we would have a debit balance, therefore a net loss. So to close the income summary, again, what do we need to do? We need to reduce it to 0. If the income summary has a credit balance, which in this case it does, meaning the revenue is greater than the expenses, will the account be closed by a debit or a credit? And again, if it has a credit balance, we close it with a debit. If it had a debit balance, meaning a net loss, we would close it with a credit. So now, in this situation, in closing the income summary when there is a net income, the capital account is credited because we had a debit in the income summary to close out the income summary account. Therefore, we need a credit of the same amount in our capital account. And here's what it looks like on our T account. We have a closing entry of $500 in income summary and a closing entry of $500 in capital under the credit. And now we'll take that information. Here we have our general journal up to this point, and we're going to enter the information for this step 3 where we transfer from the income summary, which is being debited for $500, to capital, which is going to be credited for $500. Now our 4th step is closing out the owner's withdrawal account. And to do this, again, we reduce the balance to 0. If the withdrawals account has a balance of $900, that's going to show on the bottom a debit of $900, a debit balance, since withdrawals have a normal balance on the debit side. So we close the withdrawals account by adding a credit, and in this case it will be a credit for $900. When we close the withdrawals account, the capital account is receiving a debit. Okay, it's debited for the balance of the withdrawals. So here we look at our T accounts. We have a closing of $900 in the withdrawals on the credit side and a debit on the capital for $900. And again, we take that information that we gathered on the T account and we're going to complete our journal entries again with the date, the day of the month. We don't need the month. Capital is debited. When we add withdrawals, withdrawals are going to reduce our capital. So capital is debited for an amount of $900, and the withdrawals account is going to be credited, which will bring the withdrawals account to a balance of 0. Alright, so just as a glance, we looked at that with given all of the pieces of information. But if we remember our steps, we created a worksheet, and then we created our financial statements from that worksheet. And now we're coming to the step where we create all these closing entries. So let's just take a quick look at how do we create these journal entries based just from looking at the worksheet. And it's really quite simple. If you remember, our worksheet is set up with all of our assets, and then our capital, our owner's equity, and then our liabilities. It's set up in a nice sequence with our temporary accounts. So we can look at this here. If you look at the worksheet sample, and it's just a portion of the worksheet there that shows the income statement and the balance sheet. That's where we're going to get all our numbers from. Again, step 1, we're taking the revenue to the income summary. So we look for all of our revenue expenses. On here we only have one called accounting fees for $12,000. So we're going to take a debit of $12,000 and a credit of $12,000 into the income summary. Now, when you look at your income statement, you can tell very quickly whether you need a debit or credit. Accounting fees on our worksheet has a credit of $12,000, so to close that out, we know we need to add a debit. Again, just looking quickly through these, income summary. We're transferring all of our expenses to income summary now. Income summary, or the expenses, have debit balances on our worksheet. So when we add them as closing entries, they are all going to have credit entries. If the expenses have credit entries, then income summary must be a debit. So again, we total up all of these expenses for a total of $3,000, giving us an income summary of $3,000, and then all of our advertising, rent, repair, utilities expenses all listed individually as a compound entry. Our next step, again, we look at the income summary. We're going to take the income summary and transfer it to capital. Our total income summary now is $9,000. We can see this on the worksheet as net income or net loss. In this case, we have a net income. Net income is listed in the debit column, so we know that we're going to list that income as $9,000 in the debit because it's back up just a minute. For net income, it looks a little bit different. We don't enter the 9,000 in the opposite column like we did for all the other balances. We had to add a $9,000. We had a $9,000 balance in our credit account, or a $12,000 balance in the credit account, a $3,000 balance in the debit account on our income statement. The difference is $9,000, which gives us a net income. Because it's a net income, what's it going to do to our capital account? It's going to increase it. meaning we need to take the money out of our balance in our income summary and put it into our capital account. Remember, the income summary does not have a normal balance side, so it doesn't function the same as the revenue and the expense accounts in that sense. Our final step then, we have our capitals account, which is going to be debited for $1,700 from the withdrawals account, which if we look up there, we see our withdrawals account has a debit balance of $1,700. Now, we need to credit $1,700 to withdrawals and debit $1,700 to our capital account. Our final steps here are preparing a closing trial balance. Remember, after the closing process, only what kind of accounts have balances? Permanent. Remember, only permanent accounts have balances. After the closing process, all the temporary accounts have been closed out, meaning they have zero balances. So temporary accounts have zero balances. So when we create our post-closing trial balance, we don't need to list them. So here we have the list of all of the accounts now, which was going to be all the permanent accounts and their amounts at the end of the accounting cycle. And just a quick look at the post-closing trial balance sheet down here. Again, we list all of the account numbers, we list all of the account names, and then indented we have a total. And then in our two columns we have a column for all of our debits, which is going to be our first column. And our debits, remember, all of our assets have a normal account balance, have a normal balance on the debit side. So all of our assets are going to be listed with a balance on the first column or the debit column. Accounts payable and capital are on the right side of our accounting equation, therefore they have a normal balance on the credit side. So those balances are going to be listed on the credit column or the second column. And again, the purpose of the trial balance, the post-closing trial balance, is to prove that after the changes we just made, our assets equals our liabilities plus owner's equity. And on this example, you can see that they match up, and that's what we want. If they don't match up, we need to go back and find the error. Now for just a couple example problems here. We want to look at the following list of account names and determine, is the account name, which accounts are debited and credited for the closing entries below. You have the first example there where we close out the balance of the withdrawals account, and you'll see that we debit the capital and we credit the withdrawals. So just take a minute, see if you can fill out 1, 2, 3, and 4, and then we'll look at the answers here. So for number 1, closing out the amount of a net loss for the period. We will debit the capital account. Remember, it's a net loss. The capital is going to go down. That means it's debited. And the income summary will be credited, because we want to close out the income summary. The income summary prior to this step had a balance in the debit side, meaning a net loss. Closing out the balance of the revenue account will be a debit to membership fees, which is the only revenue account listed, and a credit to income summary. Closing out the balances of the expense account. Income summary will be debited. Remember, the income summary stores the expense balances in the debit side. The income summary stores the revenue balances in the credit side. So, for closing out the balances of the expense accounts, the income summary is debited, and each of the rent expenses, in this case, or each of the expense accounts, in this case the rent expense and utilities expense, would be credited. Finally, we have closing out the amount of net income for the period. Income summary would be debited, and capital would be credited. Another example here to practice. So look at these accounts, look at the balances that are listed on the worksheets, and I want you to think about when we close out the balances at the end of the cycle, which of these accounts is going to need a closing entry? So take a minute here and just write yes or Y in each of the accounts that you think should get a closing entry. So we go down through the list: cash in bank, accounts receivable, supplies, equipment. Those are all assets. Those are permanent accounts. They don't require a closing entry. Accounts payable, that's a liability, no closing entry there. But capital is a permanent account, but because all of our temporary accounts are going to be closed and consolidated into capital, the capital account does require a closing entry. And then you'll see all the rest: the withdrawals, income summary, cleaning fees, and all of our expense accounts. They are all temporary accounts, therefore they do require a closing entry, and they are closed at the end of the accounting period. For our last examples, again, we're going to look at the different steps, and you want to look at the list of accounts given to you and decide which accounts are going to be debited, which are going to be credited. So when we close the revenue account in number 1, we're going to debit the fees account, and we'll credit the income summary. When we close out the expense accounts, we're going to debit our income summary account, and I, J, K, and L, all of the expense accounts, are going to be credited. Now we're going to take the closing entry for the income summary and record that into the capital. And it says to assume that there's a net income. So income summary will be debited to balance out the credit balance on income summary. And Marika Hayes' capital account will be credited. And the last step, recording the closing entry for the withdrawals account. We have a debit to the capital account and a credit to the withdrawals account to close that out. And that wraps up our review of the steps and the process for Chapter 10. Feel free to watch this as many times as you want. Also to go out to Moodle and reference the website and the tutorials provided by the textbook if you have further questions or want more review.